They will tell you to study harder. They will tell you to find a better indicator. They will hand you a system, a strategy, a set of rules carved into a laminated card, and they will tell you that this is the answer. I spent 11 years in this market before I understood something so fundamental, so devastatingly simple, that I sat back in my chair and laughed, not the laugh of a man who has found joy, but the laugh of a man who has finally understood the joke that was always being played on him. The market does not destroy traders because they are stupid. It destroys them because they believe they are smarter than the crowd, and yet they are the crowd. My name does not matter. What matters is what I have seen. What matters is what I have survived. I have watched men, brilliant men, educated men, men with degrees from institutions that would make your chest fill with pride, walk into this market and lose everything. Not once. Repeatedly. Faithfully. As though loss were a religion they had chosen and could not abandon. And I've asked myself for years, why? Why does the market take from the many and give to the few? Why does the retail trader, armed with charts and patterns and moving averages, almost always find himself on the wrong side of the trade? Why does knowledge, all that knowledge, so rarely translate into profit? The answer, I have come to believe, lies not in the charts. It lies in the man looking at them. But today, I want to give you something rare. I want to give you the map that Richard Wyckoff drew over a century ago, a map so accurate, so psychologically precise, that it describes the behavior of modern markets as though it were written yesterday. Not because the markets have stayed the same, but because the people inside them have. Human nature does not upgrade itself like software. Fear is still fear. Greed is still greed. And the operators, those large, patient, institutional forces that move markets quietly and methodically, they have always known this. Today, you are going to understand what they know. Let me tell you about the first trade I ever regretted, not because I lost money, but because I understood only afterward exactly why I had lost it. I had been watching a stock for weeks. I had done what I thought was due diligence. I had drawn my support lines, my resistance zones. I had my entry, my target, my stop. Everything was clean on paper. And then, one morning, the stock began to move. It broke through resistance on high volume. The candles were green and strong. The momentum indicators were confirming. And something inside me, something hot and electric, said, "Go. Now. Don't miss it." I entered at the top of the move. 2 days later, the stock was trading below my original support. 3 weeks after that, the whole pattern I had built my thesis on had been erased, quietly, as though it had never existed. I sat with that loss for a long time. Not the financial loss that healed eventually. I sat with the question, why did I chase? Why, when I knew the rule, wait for the pullback, wait for confirmation, wait did I abandon everything the moment the price began to move? The answer is the crowd. And I was part of it. Here is something they will never teach you in any course, in any book about technical analysis, in any seminar where a man in a tailored suit stands before a crowd and promises you an edge. The reason most retail traders lose is not analytical failure. It is emotional surrender. It is the moment, and every trader knows this moment, when the rational mind steps aside, just briefly, just for one trade, and something older and deeper takes the wheel. Jesse Livermore called it the enemy within, and he was not speaking metaphorically. The crowd in financial markets is one of the most powerful forces in existence, not because the crowd is smart, but because it is large, and because it moves on feeling rather than fact. The crowd buys because others are buying, it sells because others are selling, and its emotional cycle, hope, excitement, euphoria, anxiety, denial, fear, despair, capitulation, repeats itself so reliably, so rhythmically across decades and centuries, that a man who understands it does not need a crystal ball. He needs patience and the willingness to stand apart. Wyckoff understood this 100 years ago. He watched the tape, that rolling ribbon of prices and volumes that told him not where the price was, but what the participants were feeling. And he noticed something that changed everything. Price does not move randomly. Price moves because someone is engineering it to move. He called them the Composite Operator. I call them simply the professionals, the institutions, the large patient money that has time horizons measured in months and years, not minutes. These are the traders who accumulate positions so large that the act of buying or selling would itself move the market if done carelessly. So they do not do it carelessly. They do it with architecture, with deliberate, structured behavior designed to accomplish one thing above all else. They need your shares, and they need you to give them willingly. Think about what it means to buy $100 million of a stock. You cannot simply place that order in the market. The market will see you coming. Prices will rise against you. Sellers will pull their offers. You will move the very thing you are trying to purchase. So instead, you do something subtle. You create conditions in which the crowd sells to you. You let the price drift lower. You allow negative news to circulate without contradiction. You permit the retail trader, eager, impatient, watching a stock that has been declining for weeks, to believe that the trend is down and will continue down. And just as he sells, just as he capitulates, just as he gives up on a position he has held for months and decides to cut his losses, you are on the other side of that trade. That is accumulation. That is the Wyckoff accumulation schematic. And it plays out every day, in every liquid market, with a precision that would seem like conspiracy if it were not simply the rational behavior of large, intelligent capital. Now, consider the retail trader during this phase. He sees a stock declining. He sees the volume spiking downward. He reads the news, and the news is always bearish at the bottom. Always. He projects the recent trend into the future, because that is what the human brain is wired to do. Our ancestors who assumed that the predator in the bushes yesterday was still there today were the ancestors who survived. That instinct project the recent past forward kept us alive on the savannah. In financial markets, it bleeds us dry. And then there is ego, the most expensive commodity a trader can possess. I have seen traders sit in a losing position for weeks, for months, because admitting the loss meant admitting they were wrong. And being wrong, not losing money, not the actual financial damage, but being wrong felt like a kind of death. It felt like an assault on their identity. Because somewhere along the line, they had made the catastrophic mistake of fusing their self-worth to their trade outcomes. When you are right, you are a genius. When you are wrong, you are broken. And because neither extreme is tolerable, you begin to manipulate reality to escape the feeling. You average down into a declining position. You move your stop-loss further away. You find reasons, on news channels and in analyst reports, to justify the belief you have already committed to. You are no longer reading the market. You are reading your own need to be right. And revenge trading. God help the trader who has discovered revenge trading. You take a loss, a clean loss, properly stopped out, the kind of loss that a professional accepts and walks away from. But something in you refuses to accept it. It feels unfair. The market cheated you. The institutions manipulated that candle against your stop, and so you jump back in, immediately, with a larger position, to reclaim what was taken. And now you are not trading, you are fighting. And the market is not your adversary. It has no awareness of you at all, but you are treating it as one. And it will humble you without mercy or malice, simply because it does not know you exist. There is a reason Wyckoff spent so much of his writing on psychology. Not indicators, not patterns. Psychology. Because he understood, even then, that the method was secondary to the mind. The best map in the world is useless to a man who cannot read his own emotional state. These are the traps. The crowd. The ego. The emotional surrender. The illusion that certainty is attainable. The belief that if you just find the right system, you will be free from doubt, free from the discomfort of not knowing. But the market will never give you certainty. The market trades in probability. And the trader who cannot sit comfortably inside uncertainty will always, always be exploited by the one who can. The day I stopped trying to predict the market and started trying to understand its behavior, that was the day everything changed. It sounds like a small shift. It is not. It is the difference between a gambler and a professional. The gambler needs to know what will happen next. The professional needs only to know what tends to happen, under what conditions, and how to position himself so that when the probable outcome occurs, he profits, and when it does not, he survives. Let me take you inside the Wyckoff accumulation schematic, not as a chart pattern, as a story. A psychological drama that unfolds in slow motion over weeks and months, visible only to those who know what they are watching. A stock has been in decline. Perhaps it fell 40% over 6 months. The news is universally negative. Retail traders who bought at the highs have been holding, hoping, rationalizing, and now, finally, exhausted, they are beginning to give up. Volume begins to spike. Not the quiet, drifting volume of indifference, but the urgent, desperate volume of people trying to get out at any price. Wyckoff called this the selling climax. It is the emotional bottom of the crowd's experience, and it is the institutional buyer's first whisper of interest. Notice what happens after the selling climax. Prices bounce not because the fundamental situation has changed, but because the supply of frightened sellers has been temporarily absorbed. The bounce is sharp. Retail traders who sold at the lows experience a moment of doubt. Did they sell too early? The bounce fades. Prices come back down, testing the lows. But now something is different. Volume on this second test is lower, significantly lower. The supply of willing sellers is thinning. The professionals note this. They begin to buy more. This phase, what Wyckoff called the trading range, is the phase that destroys retail traders most efficiently, because it goes nowhere. Sideways, up a little, down a little. Weeks pass. Months. The trader who bought the bounce watches his position go flat and concludes the stock is dead. The trader who shorted the bounce watches the stock hold its lows and concludes there is no downside left. Both of them, confused and impatient, eventually leave. And as they leave, they sell or cover into the hands of the very patient institutional buyer who has been waiting for exactly this emotional exhaustion. The last point of support. The spring. These are Wyckoff's terms for the final acts of the accumulation drama, the moments when price drops below the perceived support level, triggering stop losses, inducing final panic selling, creating one last opportunity for the composite operator to fill his position before the move begins. The spring looks, to the untrained eye, like confirmation of the downtrend. It is, in reality, the last trap before the reversal. Now, how does a trader with this understanding behave differently? First, he is patient. He does not chase the initial bounce. He does not chase the breakout from the trading range. He waits for the test, the moment when price, after a breakout, returns to retest the broken resistance turned support on reduced volume. That is his entry. Not the excitement, not the momentum, not the fear of missing out, the test, the confirmation, the quiet moment after the crowd has committed and the professionals are still holding. Second, he manages risk with precision rather than hope. He knows, before he enters the trade, exactly where his thesis is invalidated. If the spring is supposed to hold, and price closes below the spring on high volume, that is wrong. That is an exit. Not a debate. Not a negotiation. An exit. The ability to define invalidation before entry is one of the most powerful mental frameworks a trader can possess. It removes the emotion from the decision. The decision was made when the trade was planned, not when the pain is being felt. Third, and this is the shift that took me the longest to make, he stops trying to be right. This sounds counterintuitive. Surely the goal of trading is to be right? But the goal of trading is to make money. And making money across many trades is a function of reward to risk ratios and consistency, not of any single trade's outcome. A trader who wins 40% of his trades but whose winners are 3 times the size of his losers is profitable. A trader who wins 70% of his trades but whose losers are twice the size of his winners is not. When I internalized probability, thinking truly internalized it, not just spoke the words, I found that losses no longer disturbed me the way they once had. A loss was not evidence of failure. It was evidence that I was operating in a probabilistic environment, and this particular instance fell into the minority. The question was not, did I lose? The question was, did I execute according to my plan? And if yes, then I had done my job, regardless of the outcome. This detachment is not coldness. It is not the suppression of emotion. It is the redirection of emotion from outcome, which I cannot control, to process, which I can. Mark Douglas spent an entire career articulating this, and he was right. The trader who is attached to outcomes is perpetually at the mercy of the market's randomness. The trader who is attached to process finds that the outcomes over time take care of themselves. Think like the composite operator. Not in terms of manipulation, you do not have the capital for that, but in terms of patience, structure, and emotional neutrality. The institutional mind does not panic. It does not chase. It does not revenge trade. It has a thesis, it has a position size, it has a plan for every scenario, and it executes that plan with the same calm repetition that a surgeon brings to a procedure he has performed 10,000 times. You can build that mind. It is built slowly, deliberately, through honest reflection and structured practice. It is built by keeping a trading journal not of profits and losses but of emotional states, what you were feeling before the trade, during, after. It is built by reading your own patterns of failure as carefully as you read the market's patterns. The market is a mirror, and it will show you who you are before it shows you where price is going. The transformation is not in learning a new method. It is in becoming a person for whom the method works, because you have eliminated the internal obstacles that would otherwise sabotage it. Wyckoff knew this. The method he left us is not a mechanical system. It is a framework for reading market psychology, the psychology of the crowd. Yes, but also your own. And the day you can sit in a losing trade, with your thesis intact, without flinching, without adding to the position out of desperation, without checking the price every 3 minutes that day, you have become a different kind of trader. There is a passage in Wyckoff's writing written in 1910, in New York, when the ticker tape was the only window into the market's soul, where he says something that stopped me cold the first time I read it. He said, the market is run for the benefit of those who understand it, not for the benefit of the intelligent, not the educated, not the well-capitalized, those who understand it. And what he meant by understanding was something deeper than analysis. He meant understanding human nature. He meant understanding that the market is a mechanism for transferring wealth from those who act on emotion to those who act on logic, and that this mechanism has operated without interruption for as long as markets have existed. Jesse Livermore went broke multiple times. Most people know this as evidence of his failure. I read it as evidence of the market's mercilessness and of Livermore's extraordinary resilience. Because each time he came back, and each time he refined his understanding. His rules about pivotal points, about the line of least resistance, about waiting for the market to confirm his thesis before committing these were not theories, they were scars. Every principle he documented had been paid for in full. He once said, "It was never my thinking that made me the big money. It was my sitting and waiting, sitting through a trend, not the clever entry, the disciplined hold, the refusal to be shaken out by the natural oscillations of price. The understanding that a major trend, once begun, tends to continue further and last longer than most participants believe possible. This is the tape-reading mentality, not the reading of a screen full of real-time data, but the reading of intention. What is the market trying to do? Is it trying to go up? Is it meeting supply at every attempt? Or is demand consistently absorbing that supply? The tape reader does not care about yesterday's earnings report or next quarter's guidance. He cares about the balance of buying and selling pressure as it reveals itself in real time through price and volume. Wyckoff built an entire methodology around this: the vertical line chart, the point and figure chart, the 9 tests for buying and the 9 tests for selling. Not mechanical rules to be applied without thought, but lenses through which to read the market's behavior and determine whether the composite operator is accumulating, distributing, or is already in markup or markdown. the accumulation schematic, the distribution schematic. These are not patterns, they are sequences of behavior. They describe the arc of institutional activity from beginning to end, the initial entry, the testing of supply and demand, the spring or the upthrust, the sign of strength or weakness, the last point of support or the last point of supply, and finally the move, the long, powerful, sustained trend that rewards the patient and punishes the late. And what happens at the end of that move? Distribution begins. The very mirror of accumulation, but now the professional is selling into the enthusiasm of the crowd that has finally arrived, late and breathless, convinced that prices can only go higher. The news is excellent. Analysts are raising targets, retail traders are borrowing to buy, and quietly, methodically, the composite operator is transferring his position into those eager hands. Wyckoff's distribution schematic shows the upthrust after distribution, the last false push above resistance that triggers buy stops, that lures in the final wave of buyers, that gives the large seller one last pool of liquidity into which to exit, and then the markdown begins. And the crowd that bought at the top will hold and hope and rationalize all the way down, just as the crowd at the accumulation bottom sold all the way to the lows. The cycle is eternal. It was eternal in 1910. It was eternal in 1929, in 1987, in 2000, in 2008, in 2020. Every crash, every rally, every bubble, every bottom, all of them contain within their structure the same fundamental psychology, the same hope and fear, the same transfer of wealth from the impatient to the patient. Market cycles are not accidents. They are the expression of human nature running through the mechanism of price discovery, and they repeat, not because history is scripted, but because people are people. Because the amygdala that fires in the retail trader's brain when he sees a red candle is the same amygdala that fired in the trader's brain in 1929. Because the dopamine that floods the system when a trade is working is just as intoxicating today as it was a century ago. The old Wall Street operators knew something that modern quants with their algorithms and machine learning models sometimes forget. You cannot fully quantify the human element. You can model volatility. You can model momentum. But you cannot model the moment when a room full of frightened people decides, simultaneously, that enough is enough, and the market gaps down through every support level on the chart. You cannot model panic. You can only survive it. And survival is the real edge. This is perhaps the most important thing Wyckoff, Livermore, and every old operator who left a record behind agreed on. The primary objective is to remain in the game. Preservation of capital is not conservative, it is the foundation upon which everything else is built. A trader who loses 50% of his account needs 100% return just to get back to even. And the mathematics of ruin are not negotiable. Once you have lost too much, the position sizing required to recover becomes its own source of destruction. Forced bets, desperation trades, the death spiral. The professional survives the bad periods. He survives them because his position sizing never allows a single trade, or a single week, or a single bad month to threaten his continued participation in the market. He treats his capital as a general treats his army, never committing it all at once, never risking it on a single engagement, always preserving the ability to fight another day. The philosophy of professional speculation is not, at its core, a financial philosophy. It is a life philosophy. It is about accepting uncertainty without being paralyzed by it. It is about making decisions with incomplete information and then living with the consequences of those decisions without allowing them to corrupt your future judgment. It is about the discipline to do the same thing, the right thing, repeatedly when the temptation to deviate is strongest. Wyckoff's method works not because it predicts the future. Nothing predicts the future. It works because it provides a structured framework for reading the present, for seeing, in the behavior of price and volume, the intentions of those who move markets. And it works most powerfully in the hands of a trader who has done the internal work, who has made peace with uncertainty, who has a plan for every scenario and the discipline to execute it without hesitation or regret. The old operators were not romantic figures. They were disciplined, sometimes ruthless, often solitary. They studied the market the way a general studies terrain, not to admire it, but to navigate it. They respected it absolutely. They never believed they had mastered it. And that humility, that perpetual respect for the market's capacity to surprise, was itself a form of edge. I think of Richard Wyckoff sitting in his office in Lower Manhattan, watching the tape roll, noting the surges of volume, the springs and upthrusts, the quiet tests that told him what the large operators were doing before the crowd understood. He was not magical, he was observant, he was patient. He had trained himself to see what others could not see, not because of superior intelligence, but because of superior discipline of attention. That discipline is available to you. It has always been available to you. The market does not care about your credentials or your background. It cares only about what you do, the decisions you make under pressure, the actions you take in uncertainty, the consistency with which you apply your principles when it would be easier to abandon them. I have been in this market long enough to watch fortunes built and destroyed, long enough to have built and destroyed my own more than once, long enough to know, with a certainty that only experience provides, that the market will outlast all of us. It was here before us, it will be here after us, and in that long continuity there is a lesson that I carry with me every single day. I sit down at this desk and open a chart. The market is not your enemy. It is not your friend. It is the most honest and impartial arena ever devised by human civilization. It rewards those who deserve reward, and punishes those who deserve punishment, not based on intelligence, not based on effort, but based on behavior, on decision-making under pressure, on the quality of the mind that is brought to bear against the most challenging psychological environment that exists. Wyckoff gave us a map. Livermore gave us the courage to sit through the discomfort. Douglas gave us the psychological architecture. But none of them could do for you what only you can do for yourself. The market will always offer another trade. The real question is whether you will be there financially, emotionally, psychologically to take it. Whether you will have survived not just the bad trades, but the version of yourself that wants to overtrade, over-leverage, revenge trade, hold too long, cut too early. Whether you will have mastered not the market but the person who's looking at it. That is the work. That has always been the work, and it never ends. Every day is a new examination. Every trade is a new question. The market asks, constantly, who are you today? Are you the trader who panicked last quarter, or have you become someone different? Prove it. If this conversation has reached something in you, if something in these words has stirred a recognition that you have been approaching this the wrong way, or that the answer you have been looking for is not in a better indicator, but in a better version of yourself, then stay. Stay and study. Not just the Wyckoff schematics, not just the price structures, but the inner terrain, the emotional history, the psychological patterns that have been costing you more than any bad trade. Subscribe to this channel not because I will give you signals or predictions. Subscribe because the conversation that needs to happen in your trading life is happening here. And the day you understand the market the way the old operators understood it through the lens of human psychology, through the patience of the professional, through the discipline of a mind that has been tested and has chosen not to break that day, you will not need me any more. And that day is the only destination that matters.